I mean, the reopening could be above what normal used to be. And by that, I mean people that weren't as affected by the pandemic probably didn't spend any money on vacations and anything, restaurants, so they got money. And then you got all the government stimulus that for people that needed help. And you add that all up, and the whole reopening, as you say, the S&P, the earnings could be 200 instead of 180, or even north of 200, because we're just underestimating how powerful the reopening could be. Then some of the fundamentals might catch up with the multiples.
Well, I agree with that, Joe. I think one of the hesitancies the investors have had, and legitimately so, is valuation. There's no doubt valuations are very high. But take the trailing 12-month PE multiple. Right now, it's like north of 30 because of depressed earnings from COVID. But if we do $200 in earnings this year and the market ends up around 4,000 or so, whatever, we're going to be selling at 20 times trailing earnings going into next year. And a 20 multiple is about just a little over average from what multiples have been in the last 30 years since 1990. So suddenly, this incredibly overvalued stock market doesn't look nearly as overvalued. It looks a little high above average, but nothing excessive. And I think people's perception of valuation could change as we go into next year, where rates are still sub 2%, and we have a kind of a slightly above average multiple, and we still have raging economic growth and earnings growth looking into 2022. So that's kind of where I'm at. I do believe that inflation is the long-term risk, and massive policy tightening could be required that could prematurely end this recovery. But I don't think that necessarily has to happen. You know, I really believe, Joe, that the leadership today has decided to run this hot. They've just decided that. Look, we've been haunted by the inflationary ghost of the 1970s for 4 decades. And we've been running the economy always with the idea that inflation just lies right around the corner. In the last couple decades, we've even accepted global stagnation. We just went through the weakest economic recovery for 10 years we've ever had in our history. And inflation is nowhere to be found. So I think they're going to try something new. And there are 2 precedents for running it hot. We ran it really hot from 1950 all the way to 1980. And we only overheated in the late 60s through the 80s. But from 1950 to 1965, we ran it very hot. GDP growth, nominal GDP growth averaged 6.5% a year, and the average yield was a little over 3% on the 10-year. So we ran growth far in excess of yields, just like we are now. And yet for 15 years, we had virtually no inflation and solid economic growth and a wonderful stock market, and yields stayed within a range of about 2 to 4%. So there's 2 different precedents. There's the 70s, which everyone's focused on, which could happen, or there's the start of what was called the Golden Era of Capitalism, 1950 to 1965, where we ran it hot and it never overheated, at least for 15 years.
Well, no, I was going to let Beck.
Jim, just tell me real quickly. Okay, thanks. Jim, tell me real quickly, what was the difference between the 70s and the Golden Era of Capitalism? Like, what was done differently?
Right.
If we could take 2 paths at this point with this running hot, what would your lesson be to make sure we don't go down the path of the 70s?
Well, that's a great question, Becky, and I've recently written some about that, but I do find a lot of commonalities to where we are today to the early 50s. And the biggest one, they both started with massive policy stimulus. World War II stimulus was often, heralded as what ended the Great Depression finally, but it also is what started the Golden Era of Capitalism. And we now just had a massive policy stimulus in 2020, which maybe we'll look back on as ending the global stagnation that Larry Summers always talks about that we've been dealing with for the last few decades. Secondly, we came into the 50s with massive savings. We had a savings rate that went way up in the 40s and 50s. It kept climbing all the way into the 70s. We now have massive savings again today going into the future. The biggest really commonality is we had lousy demographics in the 50s, like we do today. We had we had labor force growth that ran like 1.25% on average over those first 15 years. And we've had labor force growth around that 1% area as well in the last 5 years or so. And going forward, we have aging demographics today. We had an aging demographic in 1950. It wasn't until the 1960s going into the 70s that we had a youth movement take over the labor force. The labor force grew at 2.5% per annum in the 1965 to 1980 period, only a little over 1% in the 50 to 65 period, and that's about where we are today.
Shepard Smith here. Thanks for watching CNBC on YouTube.